Welcome, everyone. Today we dive into the exciting world of ESG investing, a trend that's shaking up the investment landscape. ESG, standing for Environmental, Social, and Governance, has become the new buzzword in the investment community. This progressive approach to investing is gaining traction, and for good reasons. It's not just about the potential profits, but also the promise of making a positive impact on our world. Modern investors are showing a growing interest in companies that are not only financially sound, but also responsible in their operations. They're seeking out businesses that care for the environment, treat their employees well, and uphold good governance practices. But, like all good things, ESG investing comes with its share of challenges. So, buckle up and hold on tight as we explore the potential pitfalls that could turn the ESG investing boom into a potential market bust. We're about to take a thrilling ride into the world of responsible investing. So, what is ESG investing? Before we dive into the challenges, let's first get a grip on what it actually means. It's like trying to understand a new type of dance without knowing the steps. And no, we're not talking about the floss or the renegade. ESG investing stands for Environmental, Social, and Governance investing. It's a strategy where investors choose companies that score well in these three areas. This is a departure from traditional investing, where financial returns are the primary consideration. Let's break it down a bit. The E in ESG stands for environmental. This evaluates how a company's operations impact the natural world. It looks at things like a company's carbon footprint, waste management, and efforts towards sustainability. It's like being the eco-friendly neighbor who separates their trash, composts, and drives an electric car. Next up is the S, or social. This considers how a company treats its employees, customers, and the communities it operates in. It's about fair wages, safe working conditions, and respect for human rights. Imagine a company being that considerate friend who always asks how you're doing and genuinely cares about your well-being. Finally, the G stands for governance. This is about how a company is run. It includes aspects like board diversity, executive pay, and business ethics. It's like the strict yet fair parent who sets the rules and sticks to them. Now here's the kicker. ESG investing isn't just about doing good. It's also about doing well. Studies show that companies that score high on ESG metrics often outperform those that don't. It's like being the class valedictorian who also happens to be the star quarterback. Who said you can't have brains and brawn? So ESG investing is more than just a fancy acronym in the investment world. It's like the triple threat of the investing world. It's got the looks, the moves, and the voice. Now that we're all ESG experts, it's time to delve into the potential issues that lurk beneath the surface. After all, even the best dance moves can lead to a tumble if not executed correctly. Scene script. ESG investing isn't all rainbows and unicorns. There are significant challenges that could potentially destabilize the market. Let's start with the lack of standardization. Currently, there is no universally accepted standard for ESG metrics. This means that two companies can report the same ESG score but achieve it in drastically different ways. It's like two chefs using wildly different ingredients but serving up the same dish. It's not exactly a recipe for consistency, is it? Next up, we have greenwashing. This is when a company or fund misrepresents its ESG credentials to appear more environmentally friendly or socially responsible than it actually is. It's like claiming you ran a marathon when you really just ran to the fridge during a commercial break. Not quite the same level of achievement, right? This lack of transparency and potential for deception can make it difficult for investors to accurately assess the ESG merits of a particular investment. It's like trying to navigate a maze blindfolded. You might make it out eventually, but it's not going to be an easy or efficient journey. Lastly, there's the potential for overvaluation. With the surge in popularity of ESG investing, there's a risk that ESG assets could become overpriced. If everyone's rushing to buy the same green stocks, demand could outstrip supply and drive prices sky high. It's like the latest must-have gadget flying off the shelves at Christmas. The hype can inflate the price, but that doesn't necessarily mean it's worth the extra cash. These challenges combined can create an unstable market environment. Lack of standardization can lead to confusion, greenwashing can breed mistrust, and overvaluation can create unsustainable price bubbles. It's a bit like trying to build a house on a foundation of jelly. It might hold up for a while, but eventually something's got to give. It's clear that these challenges pose serious risks. But before we continue, a quick reminder, if you're finding this content useful, show some love. Hit that like button and subscribe to the channel. It's a small action that makes a big difference, helping us to continue providing you with insights into the world of ESG investing. We appreciate your time and support as we navigate these complex topics together. Is there a better way to spend half a minute? I think not. Thanks for your support. Now let's continue our journey through the ESG investing landscape. The challenges we've discussed could lead to something much more serious: market instability, or even collapse. Now that's an alarming thought, but let's not jump the gun and instead delve into why this might be a potential outcome. The essence of ESG investing lies in its focus on long-term sustainability. But the problem arises when we start prioritizing the ESG scores over financial performance. This could lead to an overvaluation of companies that score high on ESG metrics, but may not necessarily be financially sound. A bubble could form, and like all bubbles, it's bound to burst at some point, causing a market downturn. Remember the dot-com bubble of the late 90s? Companies with a mere idea and .com in their name were valued at astronomical amounts, but when the bubble burst, it led to a significant market downturn. Similarly, the lack of standardization in ESG metrics could also lead to market instability. Investors might be basing their decisions on inaccurate or misleading data, leading to misallocated resources. This could potentially trigger a domino effect, causing a market-wide correction when the true value of these ESG investments is revealed. Lastly, as ESG investing becomes mainstream, there's a risk of herd mentality setting in. Investors might start following the crowd without fully understanding the implications of their investment decisions. This could in turn lead to irrational exuberance, a term coined by Alan Greenspan, former chairman of the Federal Reserve, during the dot-com bubble. And when this exuberance fades, it could lead to a sharp market correction or, in the worst case, a collapse. The potential for a market collapse is a sobering thought, but it's not all doom and gloom. The key lies in striking a balance between ESG factors and financial performance, ensuring accurate and standardized ESG data, and promoting informed investment decisions. And that, dear friends, is the tightrope walk of ESG investing. But don't worry, we're all in this balancing act together. While the risks are real, there are ways to effectively manage them. It's like navigating through a storm. You might get wet, but there are ways to reach the other side relatively unscathed. Firstly, regulatory oversight can ensure that ESG-related disclosures are accurate and reliable. Picture this. You're buying a used car, but there's no regulation. You're told it's in top condition, but it turns out it's a lemon. That's frustrating, right? Similarly, without proper oversight, ESG investing could be like buying a lemon. Regulatory bodies can play a crucial role in ensuring that companies provide accurate and meaningful information about their ESG performance. Secondly, increased transparency can help mitigate the risk of greenwashing. Now, you might be wondering, what on earth is greenwashing? It's like washing your car with green paint and selling it as an eco-friendly vehicle. It might look the part, but it's not really helping the environment. In the world of ESG investing, greenwashing refers to companies exaggerating or misrepresenting their environmental credentials. By promoting transparency, we can ensure that investors have a clear picture of a company's true ESG performance. Lastly, investor education is key. Knowledge is power, after all. An educated investor can make better decisions and is less likely to fall prey to misleading ESG claims. It's like going on a safari. If you know which plants are poisonous and which animals are dangerous, you're less likely to have an unpleasant surprise. Similarly, an educated investor can navigate the ESG landscape more effectively and make more informed decisions. So, there you have it. Regulatory oversight, increased transparency, and investor education can help address the challenges associated with ESG investing. And remember, every cloud has a silver lining. Even in the toughest challenges, there are opportunities for growth and improvement. With the right approach, we can navigate these challenges and continue to drive positive change through ESG investing. As we wrap up, let's ponder over the future of ESG investing. We've delved into its rise, understood its essence, and confronted its challenges. From potential market instability to the risk of collapse, these issues underline the importance of effective management. However, if addressed, ESG investing could shape a future where profit and principles go hand in hand. Thank you for watching. Remember to hit that like button if you found this video useful, and don't forget to subscribe before you leave. We appreciate your time and look forward to seeing you in our next video.